Hello and welcome back to your second lesson in this introductory course. This is the Trading Methods and Account Basics lesson. Let's get right into it. So firstly, we spoke about trading or short-term trading in the last lesson. Let's now talk about the types of short-term trading. So trading can be divided into different styles, such as scalping, day trading, and swing trading, and this depends on the duration and frequency of the trades. So let's start with scalping. Scalpers will often engage in very fast trading, entering and exiting positions within seconds to a few minutes. And these are different from day traders. Day traders typically hold trades for minutes to hours within the same trading day. And lastly, those with the longest duration, swing traders. Swing traders generally hold trades from one day to a few weeks or even months. Scalpers and day traders will often execute thousands of transactions per year as they are in and out within minutes and hours, while swing traders may be in the hundreds given they hold for days to weeks. So now that we know the types of trading involved, let's also talk about the types of positions a trader can take. These are long versus short. So all three types of traders will take both sides of the trade as they seek to capture what they perceive as the best areas to buy or sell in a short space of time. What does this mean? Traders can go long, or in other words, buy a stock, or short a stock. Most persons are comfortable with the concept of buying a stock and benefiting from it going up and selling at a higher price. However, the concept of benefiting from a stock going down is foreign to most. This is called short selling or shorting. This process involves, let's start with the 5-step process. Firstly, the trader first has to have a margin account and then borrows the stock from their broker. Then the trader sells it to the market at the current price. The trader will then do this in hope to buy it back cheaper if price goes down and return it to the broker and keep the difference. However, if the stock price continues to go up, the trader will have to buy it back at a higher price if they don't have enough capital to support their position, and they lose out on the difference in the purchase price and the return price. This can be very dangerous from what you've heard so far because stocks don't have a limit to the upside. However, they can always go down to zero. So there is a cap on the downside and they can always continue higher. Therefore, it becomes even more important to manage risk when engaging in shorting and short selling. We will continue to discuss this concept in more detail as the lessons continue. So you heard me talk about margin in the shorting process. Well, we're going to discuss two concepts in this section. As I said before, we mentioned margin earlier, and there's also the concept of leverage. To capitalize on smaller movements, traders will borrow from their broker to fund larger positions. This is called leverage. With these larger positions, they are exposed to higher risk, but also able to achieve higher reward. So how does leverage and margin work? Let's start with leverage. Leverage trading means that you are trading with borrowed capital from the broker in order to increase your buying power. The broker will advise the trader of the leverage available to them, and in stocks this can range from 2 to 1, which means 2 times your initial capital or higher. This ratio is referring to the multiple that your buying power is amplified by. For example, a 4 to 1 leveraged account of $5,000 is entitled to buy instruments up to the value of $20,000. In stocks, there's a distinction between day and overnight leverage levels. Normally, to limit risk exposure overnight, most brokers limit the leverage for overnight positions. So, as you would expect then, swing traders will normally take smaller positions because of the smaller leverage available to them, but they can also achieve larger moves in their favor because they're able to hold on to positions for much longer periods of time, and this can generate higher returns. Let's now talk about margin. Margin is the amount that the broker requires from a trader when entering a short or leveraged position. The margin may change between instruments and will be higher on volatile instruments and lower on more stable instruments, and also according to the broker's preference. Margin levels may change at any time, and trading a high margin instrument will eat into the buying power of the trader and should be avoided if possible. So now that we've defined margin and understand what leverage is, let's look at how the two work and start by looking at the pros and cons of leverage. You will often hear the phrase in trading that leverage is a double-edged sword. So let's look at both sides of that sword, discussing the advantages and disadvantages of using leverage. So let's start with the advantages of trading a leveraged account. You get increased buying power for free if it's not used overnight. When using overnight leverage, there is interest charged. Secondly, you have the ability to trade higher and larger positions and as such achieve more profits. Remember, when you have leverage, you're borrowing funds and capital to invest more into a position. And this also allows you to trade more instruments and spread the risk amongst more trades, so you have a more diverse approach to trading the different instruments. The disadvantages of using leverage, however, are the risk increases on every leverage traded position, meaning that once you increase the size of your position, obviously you're taking on greater risk as the downside increases. When using higher leverage levels, your capital is more at risk, and the smallest mistake, especially when you're over leveraged, can terminate the account and deplete that capital. And also, overnight leverage is a loan and it carries interest rate payments to the broker, so that can also eat away at your capital. So this has to be considered and used wisely. We'll continue to discuss the concept of margin and leverage in more detail as the lessons continue. So, in our final section, let's go through an example. So, let's look at this example where a trader has an account value of $10,000 with 4-to-1 leverage. This means that he can purchase instruments up to a maximum of $40,000, or he has $40,000 in buying power. If the trader enters a buy on Amazon at the open for the price of $150.50, how many shares can they buy? So to your left, you'll see the chart of Amazon displayed on the laptop screen. This is a 5-minute chart on the platform, and you'll be able to see this on a daily basis on your platform. So this is an example chart. So going back to it, if the trader wanted to buy at the price of $150.50, how many shares could they buy? They would be able to afford, let's use a mathematical calculation, $40,000 divided by 150.50 cents, and that will equal approximately 265 shares with the leverage available to them. The margin would be the $10,000 capital, how much they would have to provide to the broker in order to borrow that maximum of $40,000 from them. This means that if the trader bought 265 shares using max leverage or all of their leverage, they would only be able to withstand a $37.70 point move against them. This is $37.70 times 265 shares, meaning they would only be able to withstand a drawdown of $9,990 before their account would be completely gone. In other words, if the price fell to $112.80, the position would be closed and the trader would suffer a loss. And that's it for your second lesson. Thanks for tuning in and looking forward to seeing you in the next lesson. Take care and bye for now.